Hey, it's Professor Chris with Beacon. In this video taken from our weekly trainings at our free group, Total Value Locked, go join it. I walk you through what is, I think, the most important byproduct of your journey here in learning to become a great DeFi investor, and that is a good investment plan. Stay tuned, watch the video, and see how we help you create an all-weather portfolio. And if you like what you see, we'd love it if you'd like the video, subscribe, and share with anyone you know who's looking to become a great DeFi investor. And of course, if you'd like to join our free group and learn more from the best in the business, it's in the description below. Good luck, and we'll see you in the next video. Today, we're going to talk about a little bit more theory with investment plans in the all-weather portfolio. So today, we're going to be talking about an investment plan. Now, why an investment plan? One thing that we talk about when we're talking about farming in there is knowing the difference between being a smart investor and a gambler. Know which one you are. Please be a smart investor. Don't be a gambler. Like I mentioned last week, treat this as a business. You don't want to make stupid decisions in a business. You don't want to do the same thing here. Be smart about it. Have a plan. Using the cliches, a failure to plan is a plan to fail. And honestly, nobody ever felt pain by making money, always, no matter how small the gains are. So, being diligent, being disciplined, understanding that, yes, there are going to be 100x opportunities. There are very few and far between. Be happy with the 1.5 to 3x that you could make in multiple situations. Come back to invest another day. That I think that's the mindset for most traders that I know. They're gonna be some great ones, and they're gonna be very few and far between. Making steady, calculated gains, continue to compound your wealth, minimizing risk. All this is part of the plan, and you should have a plan, because the moment you don't have a plan, that's when you're going to get wrecked. And I can tell you this from experience. I've been wrecked multiple times, and I am happy to share that experience with you all. Mainly because I just went in there guns blazing and just trying to make as many, shitcoin moonshots as possible. And you open yourself up to really bad things. It's not fun. But you can come back, you can rebuild, be smarter about it, and in most cases be better than you were last time. So what are the must-dos of an investment plan? First of all, you need to know your risk tolerance. It's very simple. Are you risk averse? You're risk neutral, like you're open to trying different things? Or are you a high-risk player? Are you a wheeler and dealer? Are you a degen, as we call them? Just know that you always have to make sure that you are willing to invest with what you are willing to lose, right? No regulation in this space. Nothing is guaranteed, but you can be smart about it. Understanding with risk, you have to know that it takes money to make money, right? So if you're not putting any money in, you're not going to be making any yields. So remember that. Understand your risk tolerance. Know where that is. Own that risk tolerance, but at the same time, understand that risk is healthy, and having a solid, comprehensive investment plan, which outlines not only your risk tolerance, not only just your allocation, but also your mindset cues. And we're not going to go into this today, but having a mindset cue with regards to just being a strong mentally, understanding the value of practice when it comes to understanding how to understand concepts. That's one thing that we're really pushing now, is just understanding what it means to practice. Practice these things. Don't run in here with thousands of dollars and just start yeeting it in every direction. Start with a small amount, practice, understand the concepts, and then as you learn the concept and master it, you can make better decisions, because it just takes reps, right? The same thing with regards to like trading. At least in the mastermind, we say that you have to do at least 100 trades before you can even say you're going to be anywhere near more than just a novice hobby trader. I'd have to say the same thing about farming, but I wouldn't say 100 farms. I would say maybe like 30 to 50 positions you'd have to put together before you probably could, get to that next level where you need to be. And also entrance and exit strategies. So essentially what this investment plan is generally it's just a spreadsheet with allocations, a tab for your mindset cues, anything that you can find that gives you mental strength, acuity, any type, not necessarily hope, but like things that get you focused, things to remember. And then writing down your exit entrance strategies for all your positions, mainly because not only is it important to track your leads, your positions and where you come in and come out of those positions, but what was going on at that time. Because oftentimes, especially in investing, regardless of the arena, most of this is cyclical, right? You're going to see a lot of the same things over and over again. So just keep that in mind. A lot of times it's important to come back and reflect on what you found. Know that there are APR risks. There are APRs for all risk appetites on chain. There are 3% APRs. And ultimately, you may find that excellent because that's more than the 0.25% you're getting in the best savings account that you have at your local bank. That's fine. If that's what you want to get, 3%, awesome. You can stake, you can do liquid staking and get 3 to 5% and be set for the next 3 to 5 years. Sit back, enjoy life. Or if you want the 3,000%, yeah, they're there. It's a little bit on the crazy side and you probably won't sleep and you might drive yourself crazy, but they're out there. And we do have members who excel and thrive in those environments. As someone who is a father of 3, happily married, I can no longer do that. I knew that within about 60 days of trying. So there's a lot that has to happen to be a high risk investor. We'll put out we had a recent talk with one of our members in the Mastermind Legacies, a very, very established now Web3 project founder on Solana. We had him 2 weeks ago on a call, giving us a lot of just his mindset stuff, and he's made it. And the guy has great insights. It's not easy being a high risk investor, but it can be lucrative. And if you set up the right things and put in the time, you can make it work for you. So, not here to judge your plan, by the way. This is your plan. It's not anyone else's. One thing I'd recommend is if you have the time and you find people like on Twitter, on social media that you follow, and you know their address, like if they have like an ENS address or something like a .eth or something, you can follow them on DBank or something like that. MetaMask Portfolio also allows you to follow them. Feel free to follow multiple portfolios. See what people are doing. Know that they may not have the right structure, at least from what we're going to talk about today, but they do have a plan, hopefully. Looking at the portfolio, seeing what people do with their allocations, pick the one that resonates with you the most. But do know that your plan is fluid and it can change based on market conditions, based on your knowledge about everything you're learning in this space as you go on this journey. And ultimately, what we want to teach you today is to how to find an all-weather solution. Now, what does that mean? What's an all-weather portfolio? It's basically a market portfolio that can do well in all market conditions. So here on the slide deck, you can see I have a couple different ways to, a couple different strategies. The barbell, where you have, 50% on one side of just high conviction, and then you have, a balancing act on the other side with the other 50. Jangle doesn't quite do a barbell, but it's pretty close. He has long hold assets, and Jangle's a very, risk neutral person. He believes in strong fundamentals. He's not really big on any big meme coins or really a lot of high risk stuff. He knows what he likes. He has high conviction in what those things, and he's going to balance that in stable coins and keep everything under pretty tight reach. You can also have just what's called a BTC and ETH portfolio, where you literally just hold but the blue chips that you believe in, and that's it. And that's perfectly fine. Don't know how you're going to make your money work for you too much in that way. Of course, you can do all kinds of farms that are just BTC and ETH, like parking assets, or if you want to do a BTC ETH LP at multiple protocols or on concentrated liquidity, that's also an option. We have what we call the 40-40-20 model. This is something that I've been, guiding people on for the last 3 years. And ultimately, these are the questions you want to ask when you have a 40-40-20 portfolio. You want to look at, or at least your all-weather portfolio, you want to look at it at if the market goes down 50%. You happy with the portfolio? Good. Now, if the market tanks another 90%, let's look back at last November, December. How do you feel then when we're looking at stink bids of $750 ETH compared to where it is right now? If you're good with your portfolio at each of those steps, then your portfolio is what we would consider all weather. And again, it's subjective, obviously. I'm not going to judge you if 50% of your portfolio is Doge or SHIB or something like that because you have high conviction in it. or even Hex, if Hex is something that you really believe in. Uh, like I said, this is your plan. We're just giving you the guidance. Most of our, pretty much all of our mastermind members follow 40-40-20, and it really works for them. And I want to share that with you now. I wrote this in Miami back at the end of October for a one of our members who flew all the way from the other side of the world to join us on a whim, because he wanted to be amongst all of us, the 30 of us that got together in Miami, as well as really just kind of get some FaceTime with us. And that's essentially what we're actually doing with ETH Denver as well. So if that's something you're interested in, just feel free to reach out. ETH Denver's at the end of February, so we'll be there. But essentially the 40-40-20 plan is this. You have 3 buckets: 40%, 40%, and 20%. I call it the 40% of the long hold, the 60% of the farming engine is what these two are. You'll have to, bear with my handwriting here, but it's pretty much 40% blue chips, 40% stables or market neutral yields, and 20% of medium and high risk, with the caveat that you have no more than 30% in one protocol. I will tell you right now, the only reason I am not here in complete shambles right now is because I had more than 30%, but I didn't have a ton more than 30% in Luna. Yeah. Had I had 80% of my protocol in Luna, like a lot of people I knew, I would not be in a very good place here talking to you all today. So that's the reason why you never want to have more than 30% in one protocol. In the event that you do, obviously there's a tolerance you need to find, but you need to try and find ways to rebalance it. Take profit. It's fine to take profit. In fact, if you don't take profit regularly, you're not doing it right, in my opinion, because you should be able to take profit, put them into cold storage, whatever you want to do, reinvest it, do whatever you want to do. But you need to rebalance regularly, and we'll talk about that in a little bit. So let's talk about these buckets. The high conviction section, the 40% high conviction hold. These are going to be any blue chip assets you really like. Doesn't matter if it's BTC, ETH. I don't care if you want to hold Link, DOT, even if it's SHIB, XRP, whatever that's there. Anything that you feel that you have high conviction in, you're going to hold for 3 to 5 years. That's going to be a long hold blue chip asset. Let me tell you, if it's kind of a shaky project, there better be a real good reason, non-emotional reason that you want to hold that for that long. Ideally, you want to make sure you have it roughly about 3 to 5 assets all together that you're holding long term. You don't need to have 20 different blue chip assets. That's a little absurd. If you want to have small little moon bags, that's a different thing, right? The 60% in the farming, so 40 and 20. 40% stablecoin or market neutral yields. We're talking about stablecoins. Also, any blue chip liquid stake tokens also count here, especially if you're farming them in a correlated fashion. So if you're doing like ETH and WST ETH, or even like SOL and MSOL or something like that. AVAX and, GG AVAX or YY AVAX or S AVAX or any of the new stuff that's out there. Those are all, liquid stake tokens that, it's pretty much market neutral because they're very well correlated, very little IL there. I think that would fit there. And then 20% medium and high risk. You'd also consider them medium. It just depends on your convictions. So essentially the 20%, it can be broken down to 15 and 5. Any way you want, really. Medium risk is going to be anything that if you read our Beacon Farming Spotlight, these are things that have a yellow dot on them. And anything with the red would be high risk. And what I mean by that is, if you want to buy SHIB, if you want to buy Pepe, if you want to buy Bonk, go ahead. Hold as much as you like. Just don't put the whole farm on it, because that's where you're going to get wrecked. Because sentiment can be a little bit crazy. And so can the narratives about meme coins. All it takes is one whale to feel like that they don't feel like holding anymore, set off a huge cascading capitulation event, and suddenly everybody is either going to be happy for a dip or they're going to be just cascading and running for the exits. Don't be one of those people whose portfolio is 80% in one asset. That's just not a good look, and that is straight that's just straight degeneracy. It's gambling. You're really just going to be preying on huge hyperinflationary events to help you out. And hopefully if you get there, take some profit, please. We all have the opportunity to eat out here. We all have the opportunity to have, once in a generation wealth generation, that type of thing. And you can keep having your wealth working for you through these systems in DeFi. Again, like I said, no more than 30% of one protocol. This is not only just for the security, because, obviously when we talk about what's the biggest risk when you're going into a project, it's obviously going to be counterparty risk. What I mean by that is the counterparty could just go away. If GMX were to disappear tomorrow for some reason, there are Lindy protocols that leave. For example, multi-chain used to be called AnySwap. One of the biggest bridges in all of DeFi. If you're not familiar with what happened, for whatever reason, the CEO, I don't even know what happened to him. He's disappeared. He got apprehended by like the Chinese authorities for doing something unbelievably stupid, or whatever the reason is. I'm not here to judge, but it kind of sent the rest of the executive team into a frenzy because they couldn't talk to the guy. It led to huge ripple effects. For example, like more than 50% of the treasury of the Phantom blockchain was tied up in multi-bridge assets, sent everything just south. Nightmares on things that you didn't think could be possible. Like, oh, AnySwap multi-chain will be here for years. They're a huge infrastructure. They're a big 100x play in my long holds. Yeah, there are stupid things that can happen that can send everything into a tailspin. So just let that be a reminder. Ultimately, just be very careful with that. Be vigilant. Stay researching. Don't fall asleep at the wheel. So what are the goals of this 40-40-20 plan? Because again, we want you to have that all-weather portfolio. We want you to have an avenue of choices. That's the key, right? You want to have the choices to invest in what you'd like. You can obviously change this around as often you want. If you want to change it around every month, you can. Every 3 weeks, every 6 months, every 2 years. It's up to you. There are new things going to be popping into the space all the time that make better sense for your allocation and your portfolio and your mindset. So just make sure you're on top of it. And that's why when we talk about routines next week, it'll be a pretty big one. You'd want to make sure that you don't farm with emotion with FOMO. FOMO, if you're not familiar with that acronym, stands for fear of missing out. And ultimately, there are lots of FOMO out there. I can tell you personally, I did not claim my Celestia airdrop because we were deep in the weeds of putting on ETH Miami, and I just couldn't go through the mechanisms to go and grab it. I'll be honest, I probably left a lot of money on the table. And I felt a lot of FOMO seeing, TIA go from like $1.25 to I think it's over $15 now. Yeah, FOMO hard, but that's okay. There's going to be more opportunities out there, and it's an airdrop, right? We want you to make sure that you can stay within your risk tolerance, and that's what these plans are for. They're for your risk tolerance. They're there to make sure that you have max gains, max protection of wealth. And again, not financial advice, do your own research. It's up to you what you want to do. But it's worked very well, very, very well for all of our mastermind members. I know the most successful mastermind in all DeFi in the world. Okay, so here's some pro tips before we move on to a couple of demonstrations. Rebalance is needed. I've already talked about that. Have a routine. We'll have a future training on this. Farm without emotion. What I mean by that is survivorship bias is one of them. Marrying your bags is another one. Lack of patience is another one as well. Be very, very cognizant of your emotions and the fundamentals of whatever you're in. If you're farming a Ponzi protocol, your time is limited in there. Keep that in mind. Don't marry something because you love the founder. Keep your wits about you. You can always come back to a protocol if things improve or come in with a better entry. Keep that in mind when you're looking at your portfolio. Don't be too diversified. That's one that I see some people, they kind of like, they want to stick in, they have like 15 or 20 different positions in their mid 40. And it's like, yeah, that's great. But if you only have like, a certain amount, you're really just kind of diluting, your share there. You want to make sure that you you want to be diversified, but you want to be too diversified. So kind of just, addition positions, rebalance them, move them around as you see better opportunities out there. I get if you don't have a ton of time. I get it. I don't have a lot of time, but have a plan, be smart about it, and stick to it. Uh, Other things I want to talk about with not to suffer from, the Dunning-Kruger effect is pretty big in this space. You're going to see a lot of people that, they think they know more than they actually do about DeFi. I don't suffer from this because I always know that there's more about DeFi that I can learn. Every single day, I talk to people that are way smarter than me, and I thought I knew a lot about what I knew. We just had an alpha call with one. If you were talking with us with Dominic Carbonaro from Avalanche, that guy is smart, and I have an inkling of a lot of the things he was talking about. I have a pretty decent fundamental understanding of most of that, but there's some stuff in there that is like super in the weeds that I can appreciate that he just knows way more about. You're going to meet people like this in DeFi all the time, and that's the most beautiful thing about being in a community like Beat the Banks, or just the Beacon Mastermind. You're just going to meet all kinds of people in this industry that know a whole lot. Just be open to learn. Be humble in the fact that you have a lot of learning to do. I even think that 4 years in, there's always going to be more that's going to be out there to learn. Because when I started, we were farming in stupid little goose finance forks with pictures of frogs, or like your token helped donations to penguins or in an endangered species around the world. Something I remember there was one that was terrible that rugged. Everybody was like, "Oh, we're gonna be helping the penguins," and 6 days later they rugged, and it was not a good time. We're way past that. We're into like full-fledged um, concepts that just escape the mind, like Pendle finance with interest rate swaps. We have things like Clearpool finance, which is under collateralized loans that could disrupt the credit industry. We have institutions with full blockchain tech, and there's a whole bunch of stuff out there. Thorchain is another one that comes up in my mind with regards to being able to have an exchange for native assets, something that you don't see on EVM because most of the assets there are wrapped. So there's a lot that's out there that have emerged. The technology is getting smarter and stronger, and not to look at it too much from an idealistic standpoint, which is something that Eric Voorhees mentioned at Permissionless this year. All of this was beautifully built without spending $1 of taxpayer money, regardless of what country you come from. That's a beautiful thing. Specifically here in the U.S., I can tell you that with regards to the financial system, that would never happen. So one thing I definitely want for you guys to consider for your plan, and this is a pretty long list. This list is much different than what the list would have looked like 6 months to a year ago. So when it comes to being an on-chain native and investing in different sectors, I want you to pay attention to a lot of these particular concepts. Specifically farming on ETH layer 2s. And these are all specifically optimistic rollups, as we call them. So Arbitrum, Optimism, Base, there we call ETH layer 2 optimistic rollups in terms of scaling. You have alternative layer 1, such as Avalanche, Solana, or Cosmos. Those are all technically Altel 1s. Altel 2s, so we're talking about ZK rollups because they have a different settlement mechanism than the optimistic rollups do. Polygon is technically a side chain, as is BNB chain or BSC or Binance Smart Chain. They started out as side chains. They're all now working to become more what we call, I guess, ZK. The Polygon ZK EVM is what they're moving to be what they call Validium, which is on par with Ethereum. But from a roll-up level on the ZK side, most likely. BNB already has a version of the ETH layer 2 called OPBNB that's based on the Optimism stack. Base themselves, which comes from Coinbase, is on the OP stack there. So those are all places that you can farm. Obviously, there's so many blockchains to cover. We can't cover all of them today. Liquid staking tokens. These are like we mentioned, WST ETH. Various other types of BTC, ETH, Solana. All of the major blockchain tokens have some sort of liquid staking to help both secure the network and provide you with extra yield that are out there. These are what we call derivatives. Real world assets, definitely coming on chain, have been for the last almost year now. The biggest one that's been coming, I guess, in terms of a popular flavor would be the T-bill version. So having T-bills on chain that you can actually um, invest in. There are other real world assets that are out there. You can tokenize anything. There are people who try to tokenize chickens, wheat, rice, oil, gold, silver, precious metals. Those are all also real world assets. Privacy coins are pretty big. There's a lot of hot prospects out there right now, specifically with the SEC being the SEC, or the CFTC being the way they are too, about regulation. If you're in Europe, with MiCA and what they're doing, uh, again, they're trying to be anti-privacy coins. They want to make sure that they know exactly how the money works. But there are coins like Monero and some of these others that are out there, um, that are going to be truly decentralized, and you want to fight for those, you can. Of course, stablecoins is popular. Obviously, native USDC is making its rounds, but Tether USDT is still the market leader with well over 65% of the market share. Um, Questions always come into uh, there's always questions about the collateralization. Where is the backing of that? But they've now said that most of it is in trackable commercial paper. It used to be, was like bad real estate bonds or something like that in like Southeast Asian markets. Not sure, but they're making a ton of money. CDP protocols, so that's like over collateralized stable coins, over collateralized liquid staking tokens. Those are all things that are out there. And then derivative dexes are huge right now. So what I mean by derivative dexes are perpetual dexes, I guess, is another way to look at it, where you can trade synthetic assets, perps, so options and futures that are out there. And when you do it in crypto, there's no expiration date for the most part. So that's what makes them great. So you can do delta neutral strategies, hedging, that type of thing. These are all things that you can consider for your plan. And if you only do two of these things, that's fine. It's up to you. But there's a lot of things to research out there and a lot of things to add to your bag if you'd like.